Guys, Ember here,
This is Steven.
and we're here with Nick Street from Mountain West Financial. We wanted to talk quickly about what kind of down payment you need to purchase a house. A lot of people still have the assumption that you need 20% down to buy a home. That's not necessarily the case. It may be something that you want to do, but if you don't have that kind of cash in the bank, you should not let that stop you from buying the home of your dreams.
Yes.
So Nick, when somebody comes to you and says, hey, I only have X amount of dollars, or I can only do X percent of a loan, what would you say to somebody like that?
Yeah, so to me, it's really important that we analyze somebody's entire financial position, right? So if they are looking to ultimately buy a house, that's a big step, and they should be well versed in kind of understanding their entire financial picture. So if they're not ready today, maybe we set up a plan to get them ready for the future, right? Your point is really important, that there's a misconception out there that people think they need more money than they actually do, right? So a first-time home buyer on a conventional loan actually only needs 3% of the purchase price.
When you say conventional loan, what does that mean?
So you have both conventional loans and you have government loans,
Okay.
right? So a conventional loan is backed by Fannie Mae or Freddie Mac. And a government loan is either going to be an FHA loan backed by the Federal Housing Administration, or a VA loan, right, which is for veterans, or USDA, which is more rural loans. So both USDA and VA actually have 100% financing options available, and FHA requires a minimum down payment of 3.5% of the purchase price. Now, I would never tell a client for them to decide on their own which loan program they want to apply for, right? It's better to talk to your loan professional and have them kind of guide you and educate you in, as to which loan program works best for your individual situation.
So the 3% down sounds really nice to me.
Yep.
Right? What's the catch around that? Like, can you tell us, like?
So there's really no catch, and to be honest, there's repeat buyers can buy with 3% in certain circumstances now with conventional loans. If you can't buy with 3, you can buy with as low as 5. So you can own 3 homes yourself and want to buy a 4th home as your primary residence, and you can buy with as little as 5% down on a conventional loan. Now the catch per se is that, anytime you put less than 20% down on a conventional mortgage, you would have private mortgage insurance.
Got it.
Right? So that number is just like an interest rate. It's determined based upon your individual qualifications. So the amount you have down, your credit score, your debt to income ratio, all of those will factor into how much you end up paying per month on the mortgage insurance. But I can tell you, from the majority of conversations I have, it's far less than people think. So the amount of monthly mortgage insurance that somebody pays on a conventional loan, a lot of times is a lower than they have in their mind. Right? A lot of people have this perception that, it's just lighting money on fire, and I would never pay
That's my
the
perception.
private mortgage insurance.
That's my
right?
perception for sure.
Well, I mean, if you think about it, if you can leverage your money, right, to invest in real estate during that same period of time it might take you to save up for that 20% down payment, well, how much equity can appreciate in the real estate that you purchase with 3 or 5% down?
Oh, that's an awesome point. Awesome point. I just had one quick question. Is it harder to qualify for FHA versus a conventional loan?
So it's a good question, and no, it's different in some aspects. So conventional is going to be a little bit more stringent on an individual borrower's qualifications, but a little more lenient on a property condition.
Okay.
And FHA is kind of vice versa. So FHA is going to be a little bit more lenient on an individual borrower, but more stringent on a property. So certain, like if you had a home with a little bit of deferred maintenance, maybe some health and safety concerns, you wouldn't want to use an FHA loan.
Okay.
Right? There's going to be more that a seller is going to be required to fix. And on a conventional loan, there's going to be more leniency on, letting that go in its current condition.
Just to clarify one thing, you mentioned if your credit was great and you had, not down payment because it's 3%, but what was the other one? Your credit and
The down payment, debt to income.
then the other one. There's one more.
Is it the job situation?
The job situation. So if those two were high, does that mean your PMI will be a little bit lower? Because
Correct.
I had a friend who actually had a situation where they put 10% down and they didn't have any PMI. And I was like, is that even possible?
That is possible. That's a whole kind of another topic in itself. So that's lender paid mortgage insurance. So you can do that with as low as 3% also.
Wow.
In that situation though, what the lender's doing is they're still paying the PMI, they're building it into the interest rate.
Oh.
So you're gonna have a larger interest rate over, the period of time, but you're not gonna have PMI up front. Now, some of that is, again, just depends upon an individual buyer's financial situation and what their goals are. If you're gonna be in the loan for a long period of time, a lot of times still the traditional PMI makes more sense, because one thing we haven't talked about is on a conventional loan, the PMI is actually temporary, right? So once you reach that equity threshold in the future of 20%, then you can apply to have the PMI removed.
Got it.
Whereas if you build it into the interest rate, you just keep that higher interest rate for the life of the loan.
I got you.
Right.
So this sounds like these are a lot of things that you would want to work out with your professional. So if I had a client or Steven had a client, could we come to you and talk about the different scenarios, and could you run the numbers for us?
Absolutely, yeah. I mean, that's what we do all day long, right?
Okay.
Is analyze somebody's ability to buy, and first of all, just determining if, again, it is the right time for somebody to buy a house.
Yeah.
And then secondly is really just help them in determining which type of loan program makes the most sense for their situation.
Okay.
And
That was
sounds awesome.
Yeah. That was very helpful. I appreciate that.
Yeah, even I learned some tips.
Yeah.
All right. So that's it for today. I'm Steven and this is Amber, and we're out.